It's not necessarily every single day where high quality dividend growth names, dividend growth stocks go on sale significantly and offer investors basically a 50% starting price discount from where they've traded historically. But in this video, we're going to go over 3 different high quality dividend growth stocks that have a history of massive price return, at least over certain time frames, and massive dividend growth historically. And the best part of all this, every single one of these dividend growth names are substantially on sale, at least as of right now, but maybe not for long. So if you want to dig into these 3 different dividend growth names and see what type of buying opportunities they could be offering as of right now, make sure to stick around, drop a like down below, and let's get right into the first one. I have some huge news for those ready to get serious about their dividend investing journey. I'm opening just 5 spots for one-on-one investing mentorship from me. I am a self-made 7-figure dividend investor who earns just shy of $7,000 per month in dividends at 31 years old. With this mentorship, you'll receive things like stock ideas, stock alerts when I buy and sell positions, access to my entire portfolio in real time, and I'm even more than happy to review your portfolio. You'll also receive my custom dividend tracker and A to Z dividend investing ebook for absolutely free. Like I said, this is only for 5 investors ready to take action, so don't miss out. The first dividend growth name that could be offering a huge buying opportunity and is significantly beat up in price is ticker symbol NKE or Nike. Now Nike, where it's trading as of right now, is offering a 2.07 forward dividend yield, which is basically double that of the average dividend that we've seen offered to investors historically. Now, Nike doesn't only have a very safe dividend, but over time, historically, the last 20 years, Nike on average has raised their dividend 15% per year, which is massive. But as we can see right here, according to Simply Safe Dividends, it says Nike faces temporary setbacks, but dividend remains strong. And this was back early July. Nike stock dropped 20% last Thursday, its largest single day percentage decrease in over 2 decades. And this was after the athletic apparel maker guided for sales in the year ahead to decline to a mid-single digit pace, and this is all while analysts had expected slight growth. Management's more somber outlook was influenced by a weakening consumer backdrop in North America and China, where consumers have pulled back spending on non-essential goods, and while the environment of more cost-conscious consumers is a definite headwind for the company, Nike's slow innovation cycle is partially blamed by lagging sales as upstart competitors like Hoka and On Running have grown in popularity. But if we zoom out a Nike stock chart on the max time frame, it wasn't all that long ago, just a few years back, that Nike was almost trading at around $170 being the recent high. Not to mention, just on the 1-year time frame, Nike stock is down around 34%, which is a massive drop, one of the biggest drops Nike has seen in several decades. Now, even the 5-year chart for Nike is grim at an 18.43% loss as far as share price goes. But again, zooming out on a longer time frame, the question of course remains, is Nike going to recover back to all-time highs? And because the potential is there, Nike could be offering an opportunity for investors, especially that have a longer time frame ahead of them. The next dividend growth name that's potentially offering a great entry, a great buying opportunity, not as beat up as Nike of course, is PepsiCo or ticker symbol PEP. Now where Pepsi's trading right now, it's offering investors a 3.16% forward dividend yield. The average 5-year dividend yield is around 2.83%, so this one is by no means as beat up as Nike is, for an example, but still could be offering a potential entry point or at least a single dividend growth name that you might want to have on your watch list. Now, PepsiCo has been in my long-term portfolio for several years now, probably going on around 6 or 7 years. And what's great about PepsiCo is that even though it's mostly traded sideways over multiple different time frames, it's offered massive dividend growth even in the last 5 years, growing their dividend around 7% or so, which has given me as an investor ever since around 2019 or so, more and more cash flow year after year. Now, PepsiCo also has 59 years of an uninterrupted dividend streak and 51 years of growth. And because PepsiCo is currently trading just around $25 off of the most recent, it could be offering a potential opportunity because if you look long term, this stock is basically traded up and to the right historically. Now, year to date, PepsiCo is actually down in the red around 1%, and year over year, PepsiCo is down around 10 or 11%, which again is offering an accidental high yield for a single stock that's been paying more and more dividends over time. Now, like I said, on the longer time frame, this stock has without a doubt made a lot of investors very, very rich. So again, maybe not the perfect buying opportunity as of right now. Maybe it is, maybe it's not, but at least worth putting on your watch list for those dividend growth investors out there. Now, number 3, the last and final dividend growth name that could be offering a potential buying opportunity, and this one has most definitely been on my personal watch list, is UPS or United Parcel Service. Now, UPS, where it's trading as of currently after the most recent earnings where it got chopped down like crazy, it's trading at around $125 to $130 per share, offering a starting yield of around 5.06%, which is more or less double that of the average 5-year dividend yield. Now, UPS does have a safe dividend, at least as of right now, but again, since the most recent earnings, it's sort of questionable exactly how safe this dividend could be moving forward. Now, it says slowing demand and rising competition pressures UPS profits, but dividend remains supported, which is good. It then says UPS saw its stock plummet around 12%. This was on Tuesday after releasing the underwhelming earnings report. It also says this drop compounds a challenging year for a delivery giant, whose shares have slipped around roughly 30% due to weaker shipping volumes, escalating labor costs, and price cuts. Earnings came in 10% below analyst expectations, adding to existing investor concerns and reinforcing worries about an ongoing economic pressure and competitive parcel delivery markets. UPS has been cutting prices this year to win back customers that were lost in 2023 during the labor dispute. An estimated 1 million daily packages were diverted to competitors like FedEx, non-union drivers, as customers worried that a potential Teamster union strike would disrupt their shipments. For context, UPS delivered an average of 24.3 million packages per day in 2022 before labor issues impacted certain customer relationships. They then go on to talk about the fact that different companies like Shein and Temu are making it extremely difficult with the super low price shipments that UPS is being stuck with. But however you want to quantify the concerns that UPS has going forward, this single stock is down around 31% on the 1-year time frame, and year to date it's currently down almost 20%. Trading very, very close to a potential buying opportunity, at least if you ask me. So for dividend growth investors like myself, it is honestly tempting to lock in some more shares of UPS and get a massive starting yield that also has been growing historically. But another concern, especially because I already own shares of UPS, is definitely dividend safety. And right now, according to Simply Safe Dividends, the dividend safety looks like it's around 69, which is safe. But again, after this most recent earnings, I think we can all agree that UPS's dividend is even less safe than before. Now, lastly, if we were to type in some of the names we talked about in this video and see what the Benjamin Graham formula valuation says is a buying opportunity or even a fair price opportunity for these different names, Nike stock, for example, is currently trading around $71, $72. And in the Benjamin Graham formula, with a 12.5% growth rate and a 25% margin of safety, Nike's fair value is around $64, or a buy zone where it's a very fair value around $48 per share. So even though it's not necessarily quite there, Nike is offering an opportunity, at least going off of this. Now, Pepsi is currently trading at $171 per share. The fair value for Pepsi is around $120 more or less, and a buy zone is around $90. And this is being extremely conservative. Honestly, for me, I'd probably start buying some Pepsi if it's around $135 to $145. But that's just going off of my personal analysis. And lastly, we type in UPS stock, it's $127 as of right now, and a fair value being around $105, 79 being a buy zone. So all three of these names, although aren't necessarily screaming buying opportunities as of this moment, it's a fact that they could be opportunities, at least going off of the information we received. But now lastly, most importantly, I have a question for you guys, and let me know down below in the comments, if I were to ask you right now what the best stock to buy is out of UPS, Nike, and Pepsi for a long-term hold, which one are you buying? Drop the ticker symbol down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.